What happens to your investments when economic uncertainty looms?
Join renowned analysts David Lin, Stephan, and George Gammon as they dissect the current market chaos shaped by inflation fears, rising interest rates, and a potential housing market downturn.
With insights meticulously distilled through AI technology, we've transformed their complex analyses into bite-sized, actionable takeaways, saving you hours of research while keeping you ahead of the financial curve.
Buckle up as we dive into smart investment strategies and critical indicators to watch.
Today, we'll examine insights from George Gammon regarding the ongoing challenges facing the stock market.
George emphasizes that stocks were down significantly amidst rising recession odds.
George Gammon suggests that the market is undergoing a significant narrative shift, indicating that bad news is now seen as detrimental.
He points out that this shift reflects growing uncertainty in market outlook.
George mentions that the rise in Treasury yields has added pressure on risk assets.
He explains that increasing borrowing costs due to higher yields could lead to further declines in stocks.
George discusses the significance of Bitcoin, emphasizing its role in indicating market risk.
He asserts that even those not invested in Bitcoin should track its fluctuations due to its psychological impact on the market.
George predicts that the Federal Reserve may need to make interest rate cuts sooner than anticipated.
This depends on upcoming economic indicators and current market conditions.
In conclusion, George advises investors to keep a close eye on Treasury yields as they are vital indicators of upcoming Fed decisions.
He also highlights the importance of Bitcoin's price movements as they indicate market sentiment and risk appetite.
Today we're discussing Stephan's analysis of the alarming downturn in the stock market.
Graham warns investors that panic selling often worsens volatility, creating a harmful cycle.
Graham explains that multiple factors, including tariffs, are destabilizing the market.
He describes how the imposition of tariffs has historically led to immediate market declines followed by brief recoveries.
Graham speculates that Trump could be intentionally influencing the market to create a scenario that favors refinancing national debt.
Graham points out that tariffs function as negotiation tactics, leading to frequent market fluctuations.
He stresses the uncertainty surrounding tariffs and their effects on investor behavior. Graham highlights the national debt exceeding $36 trillion, complicating fiscal planning as interest rates rise.
If a market crash results in lower interest rates, refinancing this debt could become more manageable.
Graham clarifies the differences between market corrections, bear markets, and potential crashes.
He points out that corrections of 10% are common and are typically followed by recoveries.
What does Graham predict for the stock market's near future?
He sees potential challenges ahead, including a bear market with substantial downturns.
In conclusion, Graham emphasizes the importance of remaining calm and concentrated on long-term strategies.
He advises against panic selling, as market volatility can often provide buying opportunities.
He also notes that good financial habits are vital, independent of market conditions. Today, we'll discuss Warren Buffett's recent statements about the housing market as seen in his annual letter and interviews.
His substantial cash reserves indicate a significant shift in his typical investment strategy.
Historically, Buffett has been a net buyer of stocks, but now he is a net seller, indicating a change in strategy.
This rise in cash reserves suggests a level of uncertainty that Buffett typically avoids displaying. Buffett's cash accumulation often precedes market downturns, indicating a potential upcoming crash.
His insights on the housing market echo warnings he made prior to significant economic crises.
Buffett's current strategy may suggest opportunities for investments during a market correction.
This raises critical questions for investors. How should they respond to potential decreases in housing prices?
Experts predict a potential market correction in the housing sector, particularly in overinflated properties.
Buffett's historical behavior suggests significant changes could occur soon.
In conclusion, it's imperative for investors to heed signals from industry leaders like Buffett and adapt their strategies.
The risk of a housing market downturn is significant, and responsiveness to these shifts is crucial for future success.
Today, we're discussing the current crisis in the luxury rental market as highlighted by Reventure Consulting.
the analysis reveals landlords are nearing collapse as they struggle with rent cuts of up to 40%.
The video illustrates how many luxury apartment buildings are struggling with high vacancy rates, and landlords are cutting rents drastically.
The analysis explains how accumulated debts during the pandemic, alongside rising ownership costs, are leaving these properties empty.
As outlined, landlords are facing an overwhelming level of debt incurred to build properties during the pandemic.
Approximately 20% of commercial mortgage debts are set to mature by 2025, leading to refinancing at significantly higher interest rates.
The discussion emphasizes rising property taxes and insurance costs, even as rents are dropping.
Commercial real estate values have reportedly decreased by 18% from their peak last year, complicating circumstances for landlords.
As a result of these challenges, many landlords are providing concessions such as extended free rent periods to attract tenants.
Such concessions can equal a discount of 25 to 33% on listed rents, signifying the competitive nature of this market.
This analysis notes that declining rental prices are advantageous for renters, offering relief during high-cost times.
However, investors may face significant risks as declining rents could signal a broader market slowdown.
Analysts anticipate a slowdown in rental prices, especially in urban centers.
Future homebuyer demand appears grim, particularly as rental markets stabilize.
The current market circumstances suggest landlords should rethink their strategies due to the rapidly evolving environment.
Simultaneously, renters are positioned to negotiate favorable deals as rental prices trend downward.
Today, we're exploring a market analysis by Chris Vermeulen, as discussed with David Lin, in the midst of significant volatility affecting equity markets.
Chris highlights the sheer panic in trading behavior, with many investors feeling the pressure to sell at any cost.
Chris Vermeulen suggests that we're entering a volatile phase in the equity markets, indicating potential for a significant pullback.
According to Chris, the panic seen in selling behaviors may lead to substantial long-term losses.
Chris explains the importance of the VIX as it spikes, indicating increased panic selling.
Such behavior typically suggests that investors are reacting emotionally rather than strategically.
What is Chris expecting for future market corrections?
Chris predicts a substantial market corrective phase, indicating a pullback potentially up to 50%.
How should investors navigate these turbulent times, according to Chris?
Chris recommends focusing on maintaining cash positions and considering inverse ETFs for potential gains in a bearish market.
What does Chris suggest about market movements in the near future?
Chris anticipates increased volatility and suggests that investors should brace for continued corrections over the coming months.
In conclusion, what key actions does Chris recommend?
Chris emphasizes that investors need to remain cautious, prioritize cash positions, and strategically assess their investments.
Hello, everyone. Today we have insights on the upcoming Consumer Price Index inflation numbers from David Lin and how these will affect the markets.
David highlights the importance of these numbers for the Federal Reserve's policy decisions.
David mentions that inflation is not showing signs of decreasing, and the Fed's aim of 2% might be far from reach.
He warns that if CPI numbers exceed expectations, the market could react strongly, notably regarding interest rates.
What are David's predictions for the upcoming CPI results?
He suggests that a higher-than-expected CPI could mean increased market volatility, indicating that traders should remain vigilant.
How might the Fed respond to rising CPI numbers?
David believes the Fed may have to maintain current rates or even increase them, which would heavily impact equity markets.
What does David anticipate for market reactions after the CPI data is announced?
He foresees a negative response in equities if the CPI is higher than expected, leading to heightened volatility.
What strategies does David recommend for traders going forward?
He advises that traders keep a close watch on CPI data and adjust their trading plans in response to changing inflation trends.
Wow, what a whirlwind of insights we've had today.
Absolutely. Each expert provided invaluable perspectives on the current economic climate.
I found David Lin's emphasis on CPI numbers particularly compelling as crucial for Federal Reserve strategies.
And Chris Vermeulen's forecast of a massive pullback really grabbed my attention.
Right? It's eerie to think many might be facing significant impacts on their retirement savings.
It highlights the importance of staying informed and calm in these turbulent times.
Speaking of staying informed, the agreement on monitoring inflation was sound, but the disagreements about market corrections were fascinating.
Yes, like Buffett's wariness towards the housing market, contrasting with Stephan's readiness to adapt.
Involvement in the housing and stock markets appears more critical than ever.
If you found this discussion as enlightening as I did, smash that like button and subscribe for more insights.
Your support means we can keep bringing you expert analyses and timely discussions.
And don't forget, we've got upcoming videos diving deeper into these trends. You won't want to miss them.